Imagine walking into a bank vault that the entire financial system depends on and finding it empty. Just silence. Because the most dangerous financial events never arrive with explosions. They arrive quietly while everyone is distracted. Over the last few months, something unprecedented has been happening inside global silver vaults. Not shortages, not delays. Complete depletion of deliverable metal. And at the center of it all is one country: China. They didn't announce a buying spree. They didn't trigger price spikes. They didn't warn anyone. They simply took the silver until there was nothing left to deliver. And when vaults hit zero, markets don't adjust. Today, we're exposing what 0 ounces left truly means. Why China moved first, and why this could be the moment the silver market quietly crossed a line it can never uncross. Stay with me, because once you understand this, you'll never look at silver prices the same way again. Welcome to Boring Silver Mystery, the channel where boring data reveals explosive realities. And it's definitely not about fear. Silver is one of the last commodities where that assumption still matters. But today, that assumption is being tested. China has been quietly removing physical silver from the system, not symbolically, not temporarily, but strategically. And in doing so, they've exposed a weakness most investors don't even know exists. It's about what happens when delivery becomes optional, when vaults become empty shells, and when paper markets lose their anchor to reality. In this video, we'll break everything down step by step: how vaults really work, what 0 ounces actually means, why price hasn't reacted yet, and why that delay is the most dangerous part of all. No noise, no exaggeration, just the uncomfortable truth hiding behind quiet data. Let's begin. When people hear 0 ounces left, they often imagine total disappearance. But in financial markets, those words carry a far more dangerous meaning. 0 ounces left refers to deliverable silver metal that can actually be handed over to settle contracts. This is the silver that anchors trust in futures markets. Without it, price becomes theoretical. Vaults may still report silver holdings on paper, but if that metal is not registered, accessible, or approved for delivery, it might as well not exist. Markets don't function on promises alone. They function on settlement. Once deliverable inventory reaches 0, the system enters a fragile state. Traders assume delivery will never be requested all at once. But history shows that when confidence cracks, delivery requests surge rapidly. China understands this vulnerability. By focusing on deliverable silver rather than total reported inventory, they targeted the weakest link in the system. They didn't remove silver randomly, they removed credibility. And when credibility disappears, markets don't adjust smoothly. They reset violently. China does not operate like retail investors or hedge funds. They don't chase headlines, and they don't bid prices higher in public markets. Instead, China uses long-term supply agreements, state-aligned refiners, and industrial offtake contracts to secure silver quietly. This approach allows metal to leave vaults without triggering sudden price reactions. Silver is withdrawn legally, gradually, and without speculation. By the time market participants notice declining inventories, the metal is already gone. This strategy avoids attention while achieving maximum impact. China understands that markets react to price, not structure. By focusing on structure, they can reshape the market without alerting speculators. This is not accumulation for profit. It's accumulation for control. Control over supply chains, manufacturing inputs, and future leverage. When silver leaves the vault through these channels, it rarely returns. It is refined, consumed, or embedded into infrastructure. This is permanent removal, not temporary storage. But once vaults approach depletion, the risk profile changes completely. At that point, even a small increase in delivery requests can overwhelm the system. Oil, copper, nickel, and natural gas all showed stress in storage data long before price exploded. When the market finally reacts, it reacts all at once. Futures markets rely on confidence that contracts can be settled in real metal. When that assumption weakens, paper volume becomes dangerous. When deliverable inventory hits 0, the market survives only as long as participants agree not to test it. China's actions increase the probability that this agreement will be tested. Once that happens, paper silver loses authority and price discovery breaks down. Silver is not disappearing into vaults, it's disappearing into factories. China leads global production in solar panels, electronics, EV components, and advanced manufacturing. All require silver. And unlike investment demand, industrial demand does not pause because of price. When silver enters manufacturing, it is rarely recycled quickly. It becomes embedded in products, infrastructure, and technology. They are absorbing it for production, continuity, and strategic independence. That makes this drain far more dangerous than investor buying. Western financial systems prioritize price signals. If price is calm, risk models remain comfortable. Vault data is boring. Inventory reports don't trend on social media. That's why these signals are ignored. They can't be. When markets finally react, positioning will already be trapped. The panic won't come from news, it will come from failed expectations. When silver becomes scarce, buyers don't negotiate price, they negotiate access. Premiums replace spot prices. Private deals replace exchanges. This fragmentation signals the end of centralized price discovery. Temporary shortages resolve through increased production. Mining timelines span years, or grades are declining. New discoveries are rare. Environmental restrictions slow expansion. Once vaults are drained, refilling them is not automatic. This is not a dip, it's a shift. China understands that once silver leaves the system, it doesn't flow back easily. This makes the current depletion irreversible in the short to medium term. One large participant requesting physical settlement at the wrong time can force repricing instantly. When systems operate with no buffer, accidents become catastrophic. When nations prepare for uncertainty, they choose assets that function without permission. China moved first because they planned first. And once physical control shifts, markets never return to the old balance. When vaults reach zero, price doesn't disappear. Truth does. History shows us that commodity markets don't fail when everyone is panicking. They fail when everyone is calm, when systems are stretched thin and no one is paying attention. China has reduced the margin for error to almost nothing. And when that margin disappears, markets don't adjust politely. If you're still here, you're already ahead of the headlines.